December, we organize our 200th webinar with a galaxy of speakers across the section. And it was mentioned in the webinar that how we have started this journey and how we have reached to this 200 marks. As you are aware that 4 o'clock on Friday, 4 to 6 is our becoming a brand and people are eagerly waiting. More than 1,35,000 people in last 4 years, they have joined our webinar and they have participated. So I'm grateful to all the participants as well as the speakers, those who have shared their knowledge. And I'm happy to announce that our speakers are from all corners, from industry, from professional, from regulator, from government, ministry, parliament, judges, and everybody. They are eager to invest their time for knowledge sharing. So I'm grateful to all of you for joining this webinar, and I'm so grateful to my learned panelists for this program. Now we want to discuss this insightful session today, the alternative investment fund. It is a concept which is not very old, but it is a new concept as per this. So this alternative investment, which we call AIF, was recognized an investment opportunity or vehicle by introduction of SEBI AIF regulation 2012 and provided a sophisticated investment tool for the high net worth individuals and investors with high risk appetite. So we are aware that in the stock market, you can invest, anybody can invest 100 shares, they can purchase 2 rupees, 5 rupees, 10 rupees. So the and SEBI is protecting them for various compliance disclosure. But here it's a separate game where the investor is also high net worth and they have a high risk appetite. So AIF has come a long way since it is becoming a most favored investment tool in country. As of September 30th, 2024, according to latest figure released by SEBI, the total investment by alternative investment fund has reached to impressive 4.5 lakh crore. Now you can understand this amount is very, very impressive as we see the investment part of this. Now the point is why this AIF drawing such mind-boggling figures. In the case of their setup of tax benefit structuring, why have fund manager and private equity fund constantly looking for establishing more AIF? The objective of this webinar is to discuss and deliberate on all these questions and the intricacies of AIF. Today, we will discuss the key discussion point in this webinar on AIF. What is AIF and type of AIF? How the AIF structure is way to go for capital investment, both in terms of investors and also on part of the startup and other investment companies. Legal and regulatory framework of AIF and procedure to create AIF. Now, all these points we will discuss today, and we will, in a way, do the complete journey of AIF, how it is becoming a very popular, what is the process, where to invest, what types of AIF, the future AIF, what is the other things. And for that, we have invited a very distinguished panelist for today. One side is regulator, second side is the people to advise for the AIF registration and AIF setup, and second is the AIF itself. So first I welcome Arpana Tyagarajan, is a Chief General Manager at the Alternative Investment Fund and FPI department at SEBI. She has over 2 decades of experience in SEBI, handling multiple segments of the capital market like secondary market, corporate finance, regulation of intermediaries. She is currently handling a policy vertical of AFT and is in charge of policy matters with regard to fund management, both AIF and PFI. It is a very, very good opportunity for all of us that Madam is there and she is in charge of this department, and she can handle the policy. So we will get the insight of things. From our side, we can read one side, but she's collecting all information, all data, and policy matter, changes in law. So she is one of the best person to explain the AIF point of view, from a regulatory point of view and policy point of view and the development point of view. I welcome Apna Madam for this webinar. This is your first webinar from SEBI. You are 2025th person who has joined. Thank you very much. Then I welcome Sanjay Singh Bhati. He is a Deputy General Manager at the Alternative Investment Fund Department in SEBI. And I'm so grateful to him because he was on leave and today he has joined just now and he is there and he will discuss about certain aspects of AIF, what people should follow when they form the AIF. Then, so I welcome Sanjay and I thanks for your pain which you have taken by joining this webinar for knowledge sharing. And these types of encouragement when we are getting, we get more charge and we plan to do more such knowledge sharing. So thank you, Sanjay, and welcome. Then we have Mr. Mahesh Gandhi. He's the head of AIF Beacon Trusteeship, and he works on that because in this AIF trusteeship is also one important thing. So he will explain about these particular aspects and some future thing for AIF connected. Then we have Mr. Ravi Prakash. Ravi Prakash is associate partner, security law and corporate litigation and corporate professional, and he will discuss about the legal aspects and some futuristic point of view on this. Then we have Mr. Shivanshu Villa. He is a founder of Partner Makia Capital, which is a AIF category 1, and recently they got the license. So he will tell us about his journey and what he wants to do that we will understand from horse's mouth. Then I have Vaibhav Malhotra, Associate Security Law and Corporate Litigation, Corporate Profession, and he will explain about the type of AIF, how the registration things can take place. So friends, you just understand this point that we have a complete set of people who are the regulator, who are the policy maker, the AIF itself, the legal part, and other things. So today we will just discuss all things, starting with the why AIF, what are the advantages, how this has come, what are the policy things, and why SEBI has come out with this concept, and what is the future they are looking for, what are the things happening in the AIF market, and how the market can further take shape, and how the market is helping economy and development of the country. So without taking much time, I will request Arpana Madam to share her point of view on AIF because she is doing the policy thing. So she knows everything about this. So she can tell us the entire journey of this, what they are planning, what is the future, and how the AIF can help in the economy. So over to you, Arpana Madam.
Thank you. Thank you so much, Mr. Pavan. Thanks a lot for that introduction. And thank you, corporate professionals team, for giving us this opportunity to interact with practitioners and people on the panel, other panelists. Thank you very much. Good afternoon, everyone. A brief introduction about me has, of course, already been made by Mr. Pavan. So in my session today, what I would like to do is to just, take you through the journey of how the SEBI AIF regulations, has evolved since it was originally notified in the year 2012. Maybe broadly touch upon the structure of how the AIF is expected to operate from a regulatory framework perspective. We will also talk about the specifications that we have in the framework, both from an investor's side and from the investments side. And then we will go on and talk about some of the recent policy measures that SEBI has prescribed. Those are more in the nature of structural reforms, I would say. So that how those reforms have shaped the industry, both currently and in the way forward. Maybe we can touch about that. So post which I will be having my colleague, Mr. Sanjay, who will be speaking subsequently on the aspects with respect to PPM and what we expect from when we look at a filing of a PPM, what all can we expect from in terms of the do's and don'ts. That part will also be covered. So to make a beginning, the SEBI AIF regulations, as you all know, they were notified in 2012. Just to start off with some statistics and the broad data points. The industry, there are about 1,400 AIFs that are registered with SEBI as at the end of November 2024. 1,431 AIFs to be precise. And the industry operates more in a commitment and investment model. So the commitments, both in terms of commitments and in terms of investments, the industry has seen a compounded annual growth rate of more than 30% in the past 5 years that we have seen. SEBI publishes very elaborate data with respect to alternative investment funds, both in terms of the breakup across categories of AIFs, or in terms of the listed and unlisted breakup, or in terms of the sectors in which the actual investments go, or to just give a color of the domestic and foreign investors' participation in the industry. So all these data points and illustrations are very elaborate, and it is disseminated by SEBI in the website under the statistics tab of the SEBI website. I would request participants to just go through that on a regular basis to understand how the industry has been growing over a period of time. The latest data that we have published is of the September quarter. The December data quarter will also be put, but as of now, the September 30 data is out. And as you can see, the commitments stand at about 12.4 lakh crore INR. And the investments made by AIFs is to the tune of INR 4.5 lakh crore. So this is again across the industry at a pan-India level. And this is being updated by SEBI on a quarterly basis. So there are quarterly reports that funds file to us as part of the regulatory requirement. And we collate this data and publish this on our website for information purpose, to just give an overview of what the activity in the industry has been like over that quarter. Now, if you look at the legal structure and the broad overview of how an AIF is set up, firstly, the AIF can be set up in all the three forms. Basically, the trust form, the fund can be set up. It can be set up in a LLP form, and it can be set up in a body corporate form. By practice, and because of the flexibility that the trust structure operates, what we have seen is more than 90-95% of the industry has preferred to go for the trust route, because they obviously find operational flexibilities in operating through the trust model. But otherwise, there are some which have chosen to operate as an LLP, and some through a couple of them through body corporates. Largely, it is driven through a trust model legal form. And the usual trinity that we call it, the sponsor, the manager, and the trustee, all the three, like you have seen in the case of the mutual fund. Similarly, you have the sponsor of the AIF, and then you have the fund manager, and then you have the trustee of the AIF, who are who take care of the overall governance and functioning of the fund itself. So that is on the legal forms in which you are permitted to set up. Likewise, both in terms of the investors that who can chip in, the regulations actually broadly talk about three categories of AIFs: Category 1, Category 2, and Category 3. Now, within Category 1, you have 5 subcategories specifically to talk about thematic strategies. For example, there is a subcategory within category 1 which is expected to invest at least 75% in infrastructure. So those are infrastructure subcategory, category 1 AIFs. Likewise, you have social impact funds, which are again expected to invest at least 75% of their corpus specifically into social sector enterprises. Likewise, you have SME funds, where you are expected to invest at least 75% of the corpus into small and medium enterprises as classified. So like these, you have, so category 1, I would say, is largely a very focused and thematic strategy fund, where you have specific investments going into the themes as has been, declared by them. And these are under the category 1 section. Likewise, you have the category 3 bucket, where category 3 is the one which can largely do more of listed investments. So they can basically do complex trading strategies, hedging, all of it. So in that case, where you have this one investments in listed securities are concerned, they can do under category 3. And what funds which do not fall within category 1 and category 3 form within the category 2 bucket. So category 2, which is more like a residual category, is the one which is I would say the predominant ones fall within category 2. In the SEBI registered AIF space, most of the AIFs fall within the category 2 space, where at least 51% of the investment needs to be made in the unlisted security space. So in that sense, the route as such is meant to channelize money from high risk, or I would say highly sophisticated investors, because the ticket size in an AIF product is 1 crore. And therefore, you have these funds, basically, they tap the potential available with highly sophisticated investors, and they channel these funds or these funding options available from sophisticated investors towards the capital requirements into alternative assets, and hence the name alternative funds as well. So by alternative assets, typically what we mean are unlisted, slightly risky, startup ventures, which are otherwise not commonly favored, say by a mutual fund, or typically considered to be or traditional investments. So these will actually cater to both the requirement of capital by these unlisted startups, or ventures which otherwise do not have access to funding or traditional sources of funding. Likewise, it also gives or operates as a potential investment opportunity for high risk HNI investors and people with slightly higher risk sophistication, where you are giving them access to alternative assets which they can park their funds in. So in that sense, I would say it is a marriage of both sophisticated investors and alternative asset classes, where you have a match both from an investor's perspective and from the investment opportunities perspective. So that is, and again, in terms of the classification, category 2 is expected to put at least 51% of their corpus into unlisted securities. The reason is, of course, because they are, supposed to be those traditional AIF funds, which are, so category 3 has a focus on listed securities, whereas category 2 is expected to largely focus on unlisted securities, where they are expected to maintain at least more than half, which is 51% of their overall investments in the unlisted space. Now, if you look at likewise in terms of the other angel funds, or for example under category 1 itself, you have in fact the registrations that we have seen for angel funds is on the rise over the past few months that we have seen, both in terms of the number of funds that are getting registered and in terms of the number of the investments made itself. We have seen a rise both in terms of the number and the investments, so which I think is a healthy trend. perhaps indicating the fact that this route is being used by investors for channelizing, or by funds for channelizing the funds of sophisticated investors towards these riskier products in that sense. Some of the major reforms as we have put in place, both under the AIF regulations itself and also within the circulars that have been issued by SEBI. So if you look at the fund itself, it is basically a privately pooled vehicle where you have a pooling of funds which is collected from the contributors or the investors to the pool. And these commitments, or whatever is the contributions that are being pooled, are drawn down based on investment opportunities that are identified by the fund managers. So in that sense, once an opportunity is identified by the fund manager actually makes a drawdown call or drawdown notice, and the commitments are drawn down, and then the investments are made after the respective agreements are being executed, both the contribution agreement, which is drawn or executed with the contributors, and the subscription agreement, which is executed between the investee company and the fund manager. So this is broadly how the fund structure operates. I would say by far, I think across the globe, if you look at the way in which alternative space has grown, I think in the Indian context, SEBI as the regulator for alternative investment funds, we have traded a very, very cautious approach where we have ensured that we balance the risks that we see in terms of what are the potential scopes for misuse of the product, with the need to cater to genuine needs of both the investors and the investee companies. So obviously, because of the flexibility that the fund operates, for example, if you look at the SEBI mutual fund regulations, okay, which is again a privately pooled vehicle with a very similar, tripartite structure, the sponsor, manager, trustee, and all that. So the SEBI MF regulations is far more tightly regulated and far more, I would say, specific in terms of the obligations and compliances that are being put in place. On a relative basis, the AIF regulations offer slightly more operational flexibility to the fund manager to manage their investments, and therefore is a very popular product to cater to the needs of both the investors and investments alike. So here again, there is no, I should say, distinction on what kind of investors that the manager can onboard. In terms of geographical bifurcation, almost 40% of the industry is foreign investors. So in that sense, we have quite a healthy participation both from domestic investors and foreign investors alike in AIFs. In terms of the structural reforms, I would say, by far, we are probably the only country in the world which has gone into 100% dematerialization of the private capital industry, both on the units space and on the assets side. So what we really mean by this is that both the units that are issued by AIFs to the contributors in the pool and the investments that the AIFs make in investee companies, that is both the liabilities or the unit side and the asset side, are entirely in dematerialization form. So what SEBI has achieved through this is that we have brought in a fairly high element of transparency in terms of the investors in the fund and in terms of the operation of the fund itself and the the investments that are being made by the fund. So you have full transparency of investors, from a regulatory purpose or from an enforcement perspective, if in case it is required. We have a full oversight of it is possible that our MIIs are prepared and are adequately equipped to cull out the list of both the investors and the list of investments of the fund. from the demat system. So that I think is a key push towards a structural reform on the from a regulatory side. Likewise, we have also recently mandated custodians to be made mandatory for AIFs. So there are some reporting obligations that are there. So maybe in the long run, we can look at seeing if we can. So, if there is data that is residing with the custody itself with respect to the assets that are being maintained, then maybe we can look at some kind of a review of the reporting requirements itself. So that is one way in which SEBI is thinking in terms of how we can go forward. Likewise, couple of other reforms, if I can touch base, there are some measures that we had announced with respect to handling the, winding. So supposing you mention, say, X years or Y years as a tenure of a fund, how does a fund manage the liquidation or selling of the assets after the expiry of tenure? So, in case there are, because, we are cognizant of the fact that the investments are made in largely, unlisted companies where it might be, less liquid than typically a listed security would be. And therefore, we have a very clear framework put in place with respect to how the liquidation scheme is to be operated. So this 1 year period at the which follows after the expiry of the tenure is what we call as a liquidation period, and the manner of liquidation of assets during the liquidation period has been spelled out quite elaborately by SEBI through the liquidation scheme framework that we have put in place. So this has been a welcome measure, both from the industry's side, the fund managers side, and from the investors, to ensure that they have a way out to see how the investments are handled, and how to really deal with any unliquidated investments at the end of fund life. So these are some of the measures. So likewise, before the AIF regulations of 2012 were born, we had this, earlier avatar of the product, which was under the VCF regulations, the SEBI Venture Capital Fund regulations, where the focus was largely on, media and ventures and early seed capital to be provided towards these projects. Now, what we had also seen was after the, although an option was given when the AIF regulations were notified, there were a lot of VCFs who continued to operate in the VCF form itself based on the registration that they had taken during the VCF regime. Now, SEBI has recently notified a very elaborate migration framework to help these venture capital funds move into the AIF regime, where certain processes have been streamlined to ensure that you actually move your license from the VCF regime to the AIF regime, and you continue to operate as an AIF. So this again is a hugely beneficial step, particularly for funds who, in fact, who have not wound up their scheme well beyond the expiry of their tenure. For those VCFs who continue to operate, this migration scheme will be a very big plus, in terms of how they can move into the back to business and kickstart their operations from where they left. So these are some of the broader measures which I thought I will just touch base. Maybe I will just pause here and hand it over to Sanjay to talk about the registration and PPM aspects and the filings that we get with respect to AIFs.
Okay. So, Sanjay, I will thank you, Madam. You have nicely put in the journey of this and the future prospects and how things is happening. It's a very interesting tool in the hands of investor now, and everybody is really enjoying. And the way the commitment amount which you have mentioned about 12 lakh crore, and then 4.5 is the investment has taken place. So you can understand the success of this particular instrument, and which will grow continuously. Before Sanjay is coming, I just want to tell two important things. Do you think that awareness is required more for this particular thing? And then the regulatory complexity of changing tax norms. These are the two important thing. And then there is a your own investment like a rate and invest is also giving a competition to the your own baby. So two segments are competing with this. So do you think that awareness is required so that more and more things can come?
Yeah. That's a very good question. So, primarily the way we are looking, we want more and more sophisticated investors to be entering into this product. So the way we are looking at it is we have an accreditation framework already. So maybe going forward, if you look at the consultation paper that SEBI had floated for AIFs, for example, sometime back. So I think our regulatory intent was made very clear, where we said that in the long run, we want only accredited investors to be making their investments through angel funds in unlisted ventures, startups. So likewise, AIFs also in that sense, although we have this unlisted and listed mix, we are looking at AIFs as a product that is meant for investors, and therefore we are looking at a situation where we maybe we the product is meant for accredited investors, where you have a SEBI designated accreditation agency who assesses and certifies the extent of sophistication of those investors. So maybe going forward, we will be looking at an accredited investor model for AIFs. That could be one way of having a good balance and fit of the both investor and investment side compatibility. I think you had asked one more question with respect to
I have
yes.
about this
So, correct.
regulatory.
The other products that, yeah. So yes, that it is true that SEBI has, multiple pooled investment products, and the frameworks for each of them, slightly vary depending on the asset class that we are targeting, and depending on the investor sophistication that we are targeting. For example, mutual fund, it's very clear. It's an out and out retail product. So REIT and InvIT, it is of course similar to AIF, but maybe again the investment strategy will be slightly different, and the asset class that they are tapping is specifically with respect to real estate and infrastructure. Whereas here, if you see, you have a very, very, I mean, if you look at the classification that SEBI has put, the sector classification, which is there in the SEBI website, there are more than 10, 15 sectors where we have seen right from your real estate to your FMCG to retail. So in that sense, the extent of diversity that we have seen, both through the investment strategies adopted by fund managers and the sectors in which these actual investee companies operate in, I would say it is very, very, very diverse as against a REIT or an InvIT. So in that sense, we do have that operational flexibility for a fund manager, particularly in an AIF product, where you can identify opportunities through a plethora of sectors and actually map the contributors' contribution towards those identified opportunities.
Are you doing something related to tax reforms also, because changing tax norms is creating problem? So SEBI is working out to popularize this instrument.
So tax pass-through status is of course available for category 1 and 2 funds. So apart from that, if there are any specific tax issues that the industry is raising with us, I'm happy to flag that up if required with the government. We are welcome for that as well.
Okay. So thank you very much. Now Sanjay, your turn. Uh, So when you're receiving application, you're doing this. So what advice you want to give so people should get higher, because there's one complexity is also there, because you have a sponsor, you have a trustee, then you have a your people the running. So sometime the purpose of this law is that more and more people should come, more and more fund can come. And today we are more focusing on the big cities, but tomorrow when the people are realizing, then they are small cities also coming into this. So more and more people will join this. So what is your call on this? Over to you, Sanjay.
Before Sanjay starts, so once again, I mean, just to clarify, Sanjay is also working with me in the policy team.
Yeah, I know.
Yeah. So the actual registration team, but then we have taken inputs and we'll be of course, he's an expert. He's handled AIFs for more than 5-6 years now.
Yeah.
In that sense, he is a veteran in the
So
industry.
Sanjay can add what you have not covered and the point. Sanjay. Yeah.
So I think I'll start with the question what you posed to Aparna about that awareness part. So the AIF industry, what we see is it runs on the solicitation. So basically, the funds are to be raised on the private placement basis. That is the first requirement. So it means that you are not going to, solicit funds from public at large. So that is why actually our focus remains that what kind of investor can participate in AIFs. So if you see the minimum ticket size which has been kept in general for AIFs is 1 crore. So ticket size is so high that we think that the retail investors will not be attracted to this investment class, considering that the investments made by AIFs are in the riskier investment avenues. So that is the idea. To filter that only the investors who have commensurate risk appetite, they only invest in AIFs. The accredited investor framework has been put in place, which Aparna just explained. So going ahead with this, I'll just briefly tell what are the key benefits actually if AIF is formed. So the main benefit is the investment flexibility. So investing in unlisted securities or unlisted sector in a regulatory framework, it is the best possible way to come through AIFs because it provides investment flexibility. What are the instruments you want to invest, whether listed or unlisted, which are the sector you want to target through those investments. That flexibility is inbuilt in the AIF framework. Then second is that the for the manager, the incentives, like what will be the charges, what will be the management fee they will be charging to the investors. That is completely left to the manager and investors negotiation. So unlike mutual fund where we are saying that there is a TER that the fund will not be charging more than a certain threshold, it is not the case in AIF. In addition, actually, because this industry runs on the risk return profile, higher risk, higher return, the flexibility has also been extended for charging the performance fee. So if the investor and manager is negotiating that if I generate returns more than 10% or 15%, then over and above 15%, whatever happens, I'll be sharing 20, 80 or 30, 70. Then that flexibility is also accorded. So that is very unique to AIFs, which provide flexibility to manager. If they perform better, they get better returns for themselves also. So that flexibility is available to AIF. Then second is the tax pass-through status. The category 1 and 2, out of these three categories, category 1 and 2 AIFs have tax pass-through status. So when we say tax pass-through status for AIFs, it is different than tax pass-through status available to mutual funds, where the tax is calculated on the difference of the NAV. But when we talk about the AIFs category 1 and 2 and say that they are tax pass-through, it means as if the investor had made the investment directly and he has exited from the investment directly. So whatever the difference of those two prices, that is charged in the hands of investors and not at the hands of the fund. So that is a big advantage to category 1 and 2 AIFs. Then there is no withholding tax applied to any payment made to AIF. So if any payments are made for services for anything to AIF, there is no withholding tax to be paid. Then there are tax exemptions available to sovereign and pension fund which invest in AIF, which invest in turn in infrastructure sector. So there are special tax incentives have been given. Then if we talk about qualified institutional buyer status. So AIFs have been given status of qualified institutional buyers under SEBI ICDR regulations. So which enables them to avail all the benefits which are designated to QIBs. Similarly, if AIF wants to subscribe to the SRs issued by ARCs, which are regulated by RBI, so only qualified buyers which are designated under SARFAESI Act, they can purchase those SRs. Here, the AIFs have been designated as qualified buyers. So if any AIF which is registered with SEBI, they want to subscribe to securities receipts, they can subscribe to securities receipt also. Then post-IPO lock-in. So post-IPO lock-in is not applicable to category 1 and 2 AIF if the shares are held at least 6 months prior to IPO. So that is also added advantage if you have an AIF in place. Then foreign investment in AIF is permitted under automatic route. So when any foreign investor is investing in AIF, if they are eligible, they can directly invest in AIF under FEMA NDI rules, and there is no requirement of taking prior approval for investment. Then if any AIF wants to make overseas investment, so funds have come into AIF and they want to invest overseas, so that is also permitted. However, there is a overall cap of AIF industry level cap, that how much AIF industry in total can send overseas. But at an AIF level, under that overall limit, up to 25% of their corpus they can send overseas. So these are the major benefits of having an AIF registration. Then I'll talk about when to apply for AIF registration. So first thing is that first we have given a detailed FAQs on SEBI website for registration related queries. So all the questions have been covered, and that you will find on SEBI website. Just type for go to FAQ section and go for FAQs for registration of AIFs. You will find all the details, but in brief, I'll tell you how to do it. So first, you have to decide that which form you want to set up the fund. So whether you want to set up the fund in trust or LLP or company form, accordingly, you have to get your incorporation things completed. Then your MOA, trust deed and partnership should clearly state the objective under the objective head that you will carry out the AIF activity. Second, these documents should also prohibit that you will not raise funds from public and you will raise funds only from private placement. Because when we see the registration application, first things we see whether these things are covered in the documents, incorporation documents. Then the applicant, sponsor, manager, and trustee has to be fit and proper person. Fit and proper person as per SEBI intermediaries regulations. So that is a routine check for all the application, not only for AIF, any other intermediary which is registered with SEBI. Their director, partners, and the key management personals, whether they are fit and proper person and they meet the criteria for fit and proper person as specified in our SEBI intermediaries regulations. So that has to be checked. That we also check when we receive the applications. Then there are certain criteria for manager specific, like for the manager has to have a key investment team, and that key investment team must have at least one person who meets the professional qualification and one person who meets the certification requirement. So that is the thing. When you apply, these things should be in place before you make application to SEBI. Then the application to clearly describe the investment objective, investment strategy, proposed corpus, tenure, target investor, where you are going to use that money, everything should be disclosed in the fund document. And then after having all these things in place, then you have to create a login on our SEBI intermediary portal, where you will create after creating the SEBI intermediary portal login, you can file an online application for registration of AIF. And when you file the registration of AIF, you have to file a Form A, where you will give details of manager, sponsor, trustee, their directors, their partners, and all the details you will upload. Then you will upload the incorporation document of the type of the entity. Then you will upload the private placement memorandum, which is basically a fund document or fundraising document. And then you will update the eligibility conditions also. And after that, you will submit the application. You get the notification that your application has been submitted. Automatically, that application is assigned to an officer in our team, registration team. And there is a set timeline within which either it has to be approved or if there is any deficiency, that has to be raised to the applicant. And once the application is approved, an intimation goes back to the applicant saying that your application has been approved, and you pay the necessary registration fee. Once the registration fee is paid, then the certificate of registration is generated and which is dispatched to the applicant. And that is how the AIF is registered. Then what generally errors we observe. So just to avoid those errors, I'll give you two suggestions. One is that to go through the standard template what we have prescribed. That is prescribed by our SEBI circular dated February 5th, 2020. In that provides the plate, template, standard template for both the kinds of AIF. Category 1 and 2, it's separate. Category 3, it is separate. You go that circular and download it, and you will find the entire set of disclosure which you are required to make in a private placement memorandum document. That is the minimum disclosure. Over and above, if you want to add more disclosures, that flexibility is there. There is a supplementary section for each section, and there you can make additional disclosures. Then when the PPM is submitted to us, the first observations what we see is that whether the template is filed has the adequate disclosure which has been described in our standard template. If that is in line, then only we go into the details, like each section whether the disclosures have been covered appropriately. But the first check is that. Second check is that we have mandatory requirement of filing the PPM through a merchant banker. So since October 2021, after 2021, all the PPMs are required to be filed through a SEBI registered merchant banker, and that merchant banker, after carrying out a vetting of the PPM, gives a due diligence certificate. The due diligence certificate is also filed with the application for registration. So that is again a check for us that whether the checks which are required to be carried out by the merchant banker, whether that have been carried out, and whether those disclosures have been made in the PPM also. So that these are two important checks. One is the template, second is the merchant banker due diligence certificate. And after that, even after that, we find that there are some applications that still have some deficiencies. So that cover like the investment strategy which is disclosed in the PPM actually is not proper. So there are the investment strategy which actually is prohibited for a kind of there is a investment avenues which are prohibited for investment, and it is disclosed in the PPM that whether that is the case or not. And then major reason of delay the application is that the eligibility conditions are not met by the manager's key investment team. So that is to be seen that before you apply for the registration application, the key investment team members are fit and proper, and they are having the eligibility requirement as mentioned in Regulation 4G of AIF regulations. That is important. And then the other things which we see in the PPMs are that not providing distribution waterfall, not providing adequate disclosures for the warehousing or for the excuse clauses or for the in specie distribution clauses. So these are the clauses actually where you have to see what we have asked you to disclose in the PPM and whether you are making disclosures in the PPMs or not. So these are basically the things where before you file AIF registration application, you carry out the checks.
Yes. Okay. Thank you, Sanjay. Thank you very much giving the direction of how to file, what specific points you have to take care, and the way you have created more than 1,000 registered entities on this AIF. It's speaking that it's becoming a very popular. And I will tell you, madam, when today, if you do education and if you can create this, there are so many people who are coming to us, AIF बनाना है. तो वो AIF के बारे में they are hearing something and then they are talking and they are working out. So if this particular thing can clearly explain to them, I think more and more AIF can be registered. And this side of fund, because this, in my opinion, this is totally different type of fund, different appetite, different investor, different approach. And AIF is also having a different approach. It will take shape because technological, the SME, the ESG, the new thing, which is infrastructure, all these things are coming. Okay. So I think very nicely covered. Now, what I'll do, we have a question answer session after the presentation. So I will request Ravi to give about this because what we have, though some introduction is given by both of you, and some evaluation is also there. Distinct approach for capital investment in different categories. So now I will request from the people, those who are doing work in this, what they think and how they are approached and what is their understanding. Over to you, Ravi.
Thank you so much, sir. I think the head start given by Aparna ma'am and Sanjay sir is really insightful. They have covered most of what I had planned to speak on, but I'll still speak on in an alternative way since you're talking about alternative investment funds. So the word itself, the terminology alternative, speaks about itself, why there was a need for bringing the concept of AIF. Because the enterprises are risky and all their needs cannot be fulfilled by way of the traditional finance routes. Therefore, there was a need to bring an alternative route to fund them. This was to bridge the gap in the capital supply primarily. And the idea was to bring a investment vehicle which would be stage agnostic and sector agnostic. And therefore, you saw uh, after late 80s when Government of India first formulated about venture capitals, thereafter formalized the regulations in 1996, leading up to the dot-com bubble. Thereafter, in the growth phase, all of it was consolidated. When the lines started becoming blurred between PE and VC players, private equity and venture capital players, all of it was subsumed under AIF regulations. As Aparna ma'am told, the window was open for them to get subsumed under the AIF category. What do they do? Why they are distinct? So I'll just cover it broadly and then quickly relate to my colleague Shivanshu. Uh, they provide long-term and high-risk capital to a wide variety of ventures at all stages of their evolution, creating stability and entrepreneurial capability. So this is also, apart from being a financial capital, this is also, in another words, and in technique, in the way the industry understands it, it is also a capability capital because you get it when you need it the most. If we look at the historical development of the industry, venture capital alone between year 2001 to 2015, there was an investment of more than $103 billion by VC capital funds. And all of this I'm speaking from a report of AIPAC, which was headed by Mr. Narayan Murthy. It was a 21 members report, although the report is nearly a decade old, but the work that was recorded by the committee members in that report laid the foundation for the growth journey of AIF that we have seen in the last decade after the AIF regulations were promulgated. As rightly stated by Aparna ma'am in a very simplistic way, it's a pooled vehicle. They say in Hindi, "Boond boond se sagar banta hai." The same way, the idea was to pool the investments from people who can afford to and who can understand the risk associated with the industry, sophisticated investors, and then use that capital to meet the needs of the industry where it is most required. So this is the general definition. The definition in law is not at variance with how generally the AIF is to be understood. It also means a fund which is established or incorporated in India, a privately pooled investment vehicle which collects from sophisticated investors, whether Indian or foreign. So you know that you can collect investments both from Indian investors as well as foreign investors for investing it in accordance with a defined investment policy for the benefits of its investors. So there are three elements: privately pooled, sophisticated investors, and you have to invest in accordance with your policy, just like the Contract Act. And now I'm speaking from legal perspective. There are two sorts of laws. There is one sort of law which tells you what you cannot do. Those sorts of laws are the FUTP law, the insider law, which are peremptory law or preemptive law. They tell you what not to do. There are certain laws which are enabling laws, like Indian Contract Act. It tells you that people can enter into contracts, lays down certain boundaries, periphery within which you can contract, and leaves other matters to your commercial wisdom. AIF is that sort of law. It's an enabling law, lays down the boundaries based on the policy measures and the experimentation that is done for policy making. And within that prudential framework, the parties are at their commercial will to define an investment policy and follow it systematically under a disclosure-based transparent regime. Can we put the presentation on screen, Shiva? So if we have to understand the stages of AIF, how the investment is pooled and how it works, it's very simple, although the devil is in detail, and Mr. Birla will tell you what complexities are faced when managing an AIF and what sort of meticulous work it requires. But to put it simply and in a superficial way, it is about pooling the money from investors in the fund, and then that money is managed by a professionally managed fund manager, and that money is deployed in investment companies, which money then generate returns, and that money is distributed back to investors. Why the AIF is need of India? We know that the India, and when compared to the entire world, is the most fertile ground for startups at the current date, with the economy showing resilience and also the money, the world looking east rather than west now. So therefore, this is to bridge the funding gaps, the capital supply gaps, to foster entrepreneurship, to enable long-term capital supply, and to ensure that the infrastructure development is aligned with our larger economic goals. Then it also encourages innovation. It also leads to economic diversification, because a lot of time the unconventional modes of financing, which AIF admittedly is, they usually focus on sectors that are high risk but high revenue generating, high return generating. And if you Mr. Birla will tell you how the successful companies that we know today were once a startup. They were supported by AIFs and these privately pooled vehicles. So it leads to economic diversification, of course, higher competition, higher quality of services, because diversification ultimately leads to that, and global capital inflow, because these are, as I said, these are risk capital. So risk capital will flow into an economy only when the ventures have that sort of worth. The value proposition that ventures are bringing is worthy enough to invite the risk capital. So therefore, it enables global capital inflow. And the recent trend, which I feel is going to be a trailblazer, is the environment, sustainability, and governance focus that is seen to be led by the AIFs in India. For today, this much from my side. I will now relate to Mr. Shivanshu Birla and request him to take forward the topic and make us understand, alongside the audience, also the complexities and technicalities of how an AIF works. Over to you, Shivanshu.
Thank you so much, Ravi.
Yes,
Good afternoon, everyone.
Shivanshu, just a minute. Shivanshu, because you have recently formed AIF, so why you have selected category 1? What is the purpose and how this is distinct approach, how you are planning to invest, how. So on a practical aspects, if you can tell us something relating to your project, your presentation. Over to you.
Sure, sir. Sure, sir. So thank you, Pawan sir, for the introduction. So I'm the founding partner at Market Capital. And Market Capital, it's a Cat 1 VC fund, venture capital fund, as we have understood the various categories in AIF. So there is category 1, 2, 3 that we have already discussed. In category 1, we have chosen a venture capital fund, and the moat of the fund is to invest in pre-IPO opportunities, invest as anchors in the IPOs, and also participate in preferential issues, right issues for select listed companies. So when it comes to selecting what kind of category we would want to go with, the first and foremost thing was the ease of compliance. So for category 1 and 2, it's pretty much laced out compared to category 3, which is more stringent in terms of reporting requirements. And as it was our first fund, obviously we'll plan to do more funds going forward, and could be cat 3 as well. But to begin with, we thought category 1 could suit our needs, because as Aparna ma'am also told, and Sanjay sir also told us that for a cat 1 and cat 2 funds, when you invest in pre-IPO, right, you have certain advantages when it comes to lock-in when you are investing in those companies which are going public. So obviously we want to have those benefits at our end as well. Not that we want to exercise it, but having that flexibility also adds a lot of comfort to us. And other than that, overall, the VC fund, we also want to back smaller sizes of companies, right? And the concentration limits in a VC fund are very relaxed. And obviously, we'll also be discussing about the tax pass-through status. Sorry. So for the Cat 1 and Cat 2, the tax is on the pass-through basis, and for Cat 3, it's taxed on the fund level. So it also helped us maintain a very lean team to manage all the operations side as well. And hence we decided that given that we are mostly into the unlisted segment, we have very restricted exposure to the listed segment when it comes to the investments. Hence, Cat 1 made the most sense to us. And obviously, going forward, when we'll have larger pool of investments, we would want to diversify our own portfolios as well. We'll be looking forward to formulate Cat 3 as well. So yeah, so that was our intent behind going with the Cat 1 fund.
Okay. Okay, Spanj.
Thank you.
So no, but this distinct approach to capital investment, some point you just mentioned.
Yes, sir. So, sir, what I wanted to cover was from an investor's point of view, and even at a very larger scale, what are the distinctive features of the AIF, right? So I think the first one, and definitely everyone would have heard it by now, is very high flexibility. So one of the key attractions of AIFs is their high degree of flexibility. So AIF offers investors a variety of strategies that can cater to diverse needs of any investor. So, for instance, within the AIFs, we have 3 categories, right? So each category focuses on specific asset classes and strategies. For example, a venture capital fund or private equity fund all fall under different categories but serve very distinctive purposes. This flexibility allows investors to tailor their portfolios to match their own risk appetite and sectoral preferences as well. And what we have seen is lately, even VC funds are getting very thematic, that they want to just do ESG or renewables. So if any investor would want to get very selective exposure to certain industries, they can obviously opt for that as well. The second is targeted focus. Okay, so another standout feature, we see that AIFs are specializing in niche sectors like infrastructure or maybe SMEs or distressed assets as well. So the specialization is incredibly valuable for any investor who have strong conviction about specific industries. For example, if you believe in green energy or fintech space, which are obviously poised for exponential growth, which I believe, you can align your investments with those sectors. This targeted approach also offers exposure to very high growth areas, but supports industries critical to India's economic development on a very macro level. And AIFs are more than just an investment tool, I believe. They are vital source for growth capital for companies which are very small scale, and maybe capital that risk capital or growth capital is not reaching those hands of entrepreneurs. And unlike debt capital or public market funds, AIF provide a risk capital that fuels innovation. They play a significant role in nurturing companies and startups, and particularly SMEs for us. The third is attraction for HNIs and institutions. Okay, so AIFs are designed for sophisticated investors, particularly very high net worth individuals who might have, a large chunk of portfolio already invested in debt and equity, and now they want to diversify into asset classes which might not be available to general public. These investors often have, substantial exposure to already the traditional investment that I just mentioned. And what AIF offers them is ability to diversify their further and take focused bets on high potential sectors. I think next slide, please. Vaibhav, can you put in the next slide? Okay, so what I'll do is I'll just mention what are the advantages of AIFs for from the investor's perspective, and the first and foremost would come to be the diversification aspect of it. Okay, the first, the traditional investments as we just talked about, fixed deposits and stocks and everything else. AIFs, on the other hand, give you access to alternative investments. Okay, so you can get access to assets such as distressed assets, which no one talks about in retail investors segment, right? So these are the underperforming assets or struggling companies with right capital and strategy, but can turn around with good amount of capital invested into them. And the second is maybe special situation funds that we see. So it's also a type of a Cat 1 AIF. So these include opportunities like pre-IPO investments or maybe assets undergoing restructuring. And the third category, the Cat 3 fund that we have, hedge funds, they employ strategies. It could be long only, long short, or arbitrage strategies to generate returns for their investors. So it just as an investor, you have to take a call which industry or which theme you would want to follow to make the most money, and then find the right investment manager who you think you can trust with your money, and then you can go forward with any investment in AIFs. And obviously with all the regulatory purview, SEBI overseeing all the operations, you can be, sit back and relax where your money is and how it is employed. Just that you have to really, trust your investment manager with everything that is happening. The second is economic growth. The second major factor is obviously economic growth. As we have already talked about, it provides risk capital and growth capital to a very, potential ideas, I would say. And it's not about all the categories. It's particularly about Cat 1 and Cat 3 funds, which provide very risky capital to these companies because they see exponential returns. And obviously, it's not like that every time investment will go, maybe 10x or 100x, but it's about taking calculated risk. And that's how, the ideas are generated. And, even, the government backing Startup India and everything else, in the end, obviously you can work on 100 ideas, but everything needs money in the end. And that's how AIFs are enabling these, capital investments in those companies or ideas. Third is obviously the most important aspect of it is why would anyone invest in an AIF? And it would be obviously for the potential of superior returns, right? Traditional investments, maybe FDs will give you 6-7%. If you invest in an ETF, can provide you 12 to 15%. But AIFs are obviously higher risk when it comes to liquidity risk because you'll have to invest for a longer period of time. But they also have a potential of providing skewed returns. It could be even in the range of maybe 100% in a year, right? All depends on what is the mode of investment, right? And these investments are generally not correlated with the public equities and everything else. So yeah, that's more or less about the distinctive advantages. Can we move on to the next slide, please? Okay, as I was telling you, when we compare it to other asset classes, right? Obviously, cash is the safest thing that you can keep with you, right? Obviously, it will provide you with no return, but it's the least risky as well. And risk reward is a very, I think it's the prettiest game that any investor is playing, and any investment manager is playing, right? It's all about finding what your risk return profile suits. And when you go forward, obviously when the risk increases in any investment, the potential of return also increases, and that's how it works. So alternative investments is one of the riskiest investments when it comes to liquidity and everything else, but you can mitigate on the risk side of things when you choose the right set of investment managers. I think you can reduce it when you choose the right sectors that you want to invest in. And that's how you skew the risk reward metrics in your favor and make more returns compared to anyone else. Yeah, on to the next slide. Growth in AIF industry, I think we have already discussed this. We have seen exponential growth in last 5 years. Until June 22, we reached a number of 7 crores. In 2017, 1 lakh crores. In 2017, it was just 1 lakh crores of commitments. In June 22, it reached 7 lakh crores. And now it's approximately, increased by 85% to 12.5 lakh crores. So it's, very high growth that we are expecting in the AIF industry even moving forward. And even I think same goes for the number of AIF schemes that are available in the market with different themes and everything else. On to the next slide. These are the top players. I think you must have heard their names. Yeah, right. Sequoia, Tiger Global. These are the VC firms who back, initial ideas, and then what they wait is they, take on the board seat. They flourish the ideas. They, provide even initial capital, and even for any entrepreneur, they provide subsequent rounds of capital as well. When it comes to hedge funds, it's Motilal Oswal, Quant, IIFL Asset Management, and Anicut, Stride Ventures. So these are all the AIFs and onto the different categories of VC, hedge funds, PE, and other asset classes as well. So Trifecta and Strides are venture debt funds. So it's a very unique combination of debt and equity that they provide to any new age startup. On to the next slide, please. I think one of the interesting examples, and I think this is the most prominent example anyone in the VC industry would give, is the investment in Zomato, right? So obviously it began in 2008 with Dipinder and Pankaj, who were the initial founders who put in their own money and created just a platform so that people are able to access a menu. And later on, they were backed by venture capital from left and right. They have raised so many rounds until even Series J, for that matter, they have raised 3.5 billion. And maybe next slide, please. And InfoEdge was the one investors which backed them in each and every round. Okay, and cumulatively they put in 147 crores in Zomato from Series A to Series F, and they currently own approximately 13% of Zomato, which now values their stake at approximately 30,000 crores, which is a return of more than 200x. So that's the game that VCs and private equity guys play. They invest in ideas, they invest in very early stage. Some of the companies obviously go bust, but some of the companies make such huge returns that it skews all the portfolio metrics for in their favor. Yeah, on to the next slide. Challenges of AIFs. So obviously, everything is not hunky dory when it comes to AIF, and obviously you'll have to take care of the uglier side as well, because obviously with the higher risk, higher return scenario, there are also some challenges that needs to be addressed. First and foremost is regulatory complexities. Obviously, you'll need to have a team which regularly reports to SEBI on each and every aspect of how your fund is performing and where are you making investments. You are liable because you are obviously deploying money of huge individuals, so you are kind of liable for that money as well. So there are sector specific risks. Obviously you personally can be long on any sector, but if that sector is not performing, your AIF might not be performing that well. And from an investor perspective, obviously there are liquidity constraints. So I think we might not have covered this, but there are two kind of funds. One is the open-ended and close-ended funds. Category 1 and Category 2 are primarily close-ended funds, but in Category 3, there could be a open-ended or a close-ended structure. And when it comes to open-ended structure, obviously you can contribute to that fund, and on a notice, you can also withdraw the funds. But in most of the other cases, the minimum tenure of a fund is 3 to 5 years that you will generally see. And once you give the commitment, your money is blocked for 3 to 5 years. Okay. You can draw it down, give it to the fund manager in tranches, but more or less you can't ask back your entire amount until unless there is a maturity or a liquidation event. So it's like your money is more or less blocked for 3 to 5 years when you provide your commitment. On to the next slide, please. And I think as an investor, you must think about this slide because as an investor, you can think about investing in mutual funds, PMS, or AIFs as well, right? But these are the differences that you should keep in mind, okay? So in mutual funds, obviously, it's a collective investment scheme with a very minimal investment amount. It's maybe 500, you can even invest 500 SIP into the mutual funds. Whereas when it comes to portfolio management service, it's an individual portfolio of portfolio that any manager can give you. So for example, if you want to have a PMS, you can tell your manager about what kind of securities you want to invest in, and then they'll shortlist those securities for you and invest accordingly. But for AIFs, it's a pool investment vehicle. If you believe in an investment manager, you just give them your money and they'll invest in however they wish to. Obviously, there is a set of investment objectives that are laid down, so you have to be on board with those those set of rules. But in the end, once you give your money, you can't pinpoint that I don't want to invest in this company or that. It's a blind pool sort of a structure, the AIF structure. And obviously all the regulations are maintained by SEBI here. For mutual funds, it's mostly liquid, securities. It could be equity, debt, listed securities only. And PMS also deals in listed securities, but AIF are very flexible. They can invest in anything, especially the Cat 3 AIF, commodities, real estate, you name it, you can have it in AIFs. Investment horizon is very short in mutual funds, and it could be medium to long term in both PMS and AIFs. But the minimum amount of investment is what differentiates it, right? So it's 50 lakh for PMS, maybe 500 for mutual funds. But for AIFs, it's 1 crore. It could vary because for angel funds, it's 25 lakhs, but for any other category, it's 1 crore. And yeah, so these are more or less, I think, the takeaways when it comes to comparing it with other investment vehicles. On to the next slide. I think I'll hand over it to.
So thank you, Shivanshu. Vaibhav, now you can just in short, because Arpana madam and Sanjay has explained. So certain point which is missed out, you can tell in this presentation we can send to all the participants so they can have a complete view. Over to you.
Firstly, I will deal with the legal aspect of the formation of an alternative investment fund. And for that, I will dive into a few terminologies that is very essential for us to understand. First is the definition of sponsor. Regulation 2(1)W of SEBI AIF regulation states very clearly that sponsor means any persons who set up alternative investment fund and includes promoter in case of a company and designated partner in case of LLPs. Coming to the definition of manager, it is defined under regulation 2(1)Q of SEBI AIF regulations. Manager, generally in the practical word, we see the manager as an investment manager, and it means under law as any person or entity who is appointed by the alternative investment funds to manage its investment by whatever name called, or may be a sponsor of the fund as well. Now coming to the definition of private placement memorandum. Private placement memorandum is a document containing the details of the AIFs, including the investment strategies, their objectives, target investors, prospective corpus, fees, and every kind of information which the scheme needs to provide to the investor for the purpose of investing in a particular scheme. Now coming to the fourth definition, this includes the definition of corpus. Regulation 2(1)H of SEBI AIF Regulation 2012 provide the definition of corpus, which means the total amount of funds committed by investors to the AIFs by way of written contract or any such document on a particular date. Now let us understand what are the categories of AIFs under law. As already discussed, I will try to wrap this up in a very summarized form. So category 1 AIF, as the law states, invest majorly in early stage ventures or social ventures fund or SME infrastructures or sectors or areas which the government or regulator consider as socially or economically desirable. So what are the types of funds registered under AIF regulations? These are firstly the venture capital funds. These funds primarily invest in early stage startups with where there is a potential high growth in the businesses. Second, coming to the infrastructure fund. Infrastructure funds majorly invest major amount, 75% of their assets at least in the infrastructure projects like road, power, and urban development. Then coming to the SME funds. These funds majorly invest in small and medium enterprise for business expansion. Then coming to social impact funds, they invest primarily on social impact areas like healthcare, education, etc. Then angel funds, it is a subcategory of social venture fund, and it raise funds from angel investor to invest in early stage businesses. Now coming to the second category of AIFs, it is defined under Regulation 34B of SEBI AIF regulations. Category 2 AIF regulations deals with a category firstly a residuary category wherein the category 3 and which includes the funds which does not include in category 1 and category 3 AIFs, and which does not undertake leverage or borrowing other than as permitted in the regulations. So what are the major kind of AIFs under Cat 2? So these includes the distressed asset fund, which invests in assets of financially distressed companies, aiming to revive them and generate returns through restructuring strategies. Then we have debt fund, which focuses on providing structured debt capital to businesses, offering a stable and a predictable returns. Then we have real estate equity oriented fund, which invest directly in equities of real estate projects for the long-term growth. Then we have fourth category, that is real estate, non-equity oriented and others fund, which provides a kind of hybrid financing to real estate projects, focusing on getting steady income along with the lower risk exposure. Now, to the third category of AIFs, it is defined under Regulation 34C of SEBI AIF regulations. Category 3 AIF regulation, alternative investment fund, employs diverse and complex trading strategies and may employ leverage, including through investment in listed or unlisted derivatives. So what are the types of funds that are registered under Cat 3 AIFs? These includes first, the hedge funds. These are the funds who uses advanced trading strategies for higher returns. Second, the long only equity fund. These focuses on investing in equity securities with a long-term perspective, aiming for capital appreciation. Then third, long-term equity fund, which employs both the long-term and short-term position in equities to ensure that the risks are also mitigated and the opportunities are also capitalized. Then we have the multi-asset fund. These are the funds which diversified their investment into various assets, including equities, debt, commodities, to optimize return and reduce risk. Then there is something called a specified alternative investment fund, which is there under Regulation 19(3)(c) of SEBI AIF regulations. So the specified AIF regulation was introduced as a fourth category through SEBI Alternate Investment Fund's Second Amendment regulations. So the Corporate Debt Market Development Fund is a type of specified fund which provides institutional framework to enhance secondary market liquidity in the corporate and bond market during stressed market situations. So this fund was specifically established to act as a backstop facility for purchasing investment grade corporate debt securities during the market disruptions. So this was a recent inclusion that was done under the SEBI AIF regulations. Now let us, after we have analyzed the different categories of AIF, it is important for us to understand the difference between the categories of AIF. So the difference is that under Cat 1, scheme can be floated only as close-ended. For Cat 2, it can only be close-ended. However, the option is granted to Cat 3, wherein the person can float open-ended or a close-ended fund at the same point of time. Then what is the sponsor commitment? The minimum sponsor commitment under law is 2.5% of asset under management or 5 crore, whichever is lower. For Cat 2, it is also same, that is 2.5% of AUM or rupees 5 crore, whichever is lower. And for Cat 3, it is 5% of asset under management or 10 crore, whichever is lower. As already discussed, the taxation perspective for Cat 1 is pass-through status. For Cat 2, it is also pass-through status. But in case of Cat 3, it is taxed at the fund level. Then coming to the minimum tenure of AIF, The minimum tenure for Cat 1 is 3 years. For Cat 2, it is also 3 years. For Cat 3, in case of open-ended fund, there is no prescribed limit. In case of close-ended fund, it is for 3 years. Coming to the concentration criteria, not more than 25% has to invest in a single company or asset in case of Cat 1. In case of Cat 2, not more than 25%. But in case of Cat 3, there is a restriction, and the restriction is pertaining to not more than 10% in a single company. Now coming to the registration fee. So what is the registration fee for Cat 1? It is rupees 5 lakh. For Cat 2, it is rupees 10 lakh. And for Cat 3, it is rupees 15 lakh. The leverage. The leverage refers to the use of borrowed funds or financial instruments like derivatives to increase the exposure of the fund to certain assets or markets. So the leverage is not available in the case of Cat 1 and Cat 2. However, in Cat 3, the leverage can be taken up to the 2 times of total fund corpus. So this is the broad differences between the categories of an AIF as prescribed through AIF regulations. Now let us discuss the eligibility criteria for setting up of an AIF. As already discussed, I will just touch upon few of the points. These include firstly, the legal structure that you draft must clearly indicate and allow you and permit you to carry on the activities of an AIF. Secondly, the fit and proper criteria as laid down under the SEBI Intermediary Regulation 2008 has to be clearly met. Thirdly, the minimum qualification and expertise. So this is the recent addition with respect to qualification and expertise that has been done by the regulator. Here in a new exam of NISM Series 19C has been introduced. And one of the members of the key investment team needs to pass this particular exam. This is a mandatory requirement. Also, at least one of the key managerial person has to have a professional qualification in finance, accountancy, business management, commerce, economics, or a CFA charter from CFA Institute or any other qualification as may be prescribed by the board. Fourth, the applicant or any other entity established by sponsor or manager has not been refused registration by the board earlier. Now let us, after understanding the categories of an AIF, it is important for us to understand the process for setting up of an AIF. So firstly, taking into consideration the background of category 1, 2, and 3, an individual needs to decide which category of AIF he wants to establish. So for that, firstly, he takes into account various factors that I have tried to cover already. So after the category has been selected, the first thing that has to be done is selecting the legal structure. So as already covered, there are 3 ways in which AIF can be floated: through trust, through LLP, and through company. But generally, what we have seen that trust is the most preferred form of structure because it grants you flexibility in fund management, tax efficiency, and simpler regulatory compliances as well. Now, after the legal structure is decided, you need to draft and execute the legal framework documentation. So, in case you have established trust, a trust deed needs to be drafted, wherein you have to outline the roles and responsibilities of the trustees, clearly laid down the investor rights, what will be the operational framework, and what is the authority of investment manager. In case of LLP agreement has to be formed. In case of a company, a due MOA and AOA has to be drafted and duly executed as per the law prescribed. After this process, we need to draft and execute an investment management agreement. So the agreement, what is an investment management agreement? An agreement between an investment manager and the trustees of a scheme that sets out the basis on which the manager will manage the portfolio of investment of the trustees and the other investors. So this is a formal agreement which takes place. So what are the major points that one needs to keep in mind while drafting a investment management agreement? So firstly, we need to clearly define the parties to the contract, that is the investment manager and the trustees. Then we have to clearly define what are the powers that will be given to the investment manager. Thereafter, we have to clearly define the roles and responsibilities of the investment manager, the fee, charges and expenses he will charge, and what will be the duration and termination of the agreement. Last but not the least, the very important dispute resolution and the governing law, which will be governing the particular agreement in question. So these are the broad pointers that I have highlighted for you while drafting the investment management agreement.
Okay.
Now,
Yeah.
what is the most important document while we set up an AIF? I would say it is a private placement memorandum. So what are the components and the chapters we need to broadly draft? I will try to put in summarized form for the same. So firstly, it is the executive summary. It will provide a brief overview of the fund's vision. Secondly, the market opportunity. It will provide the market context and investment rationale, identify the growth opportunities and sector-specific drivers. Then we have investment objective strategy and process chapter, which outlines the investment objectives, target sectors and allocation strategies. Then we have governance structure, wherein we highlight the decision-making process of the mechanisms that will be done. Thereafter, we have the track record of investment manager, wherein we will try to showcase the track record of the investment manager in the past and its achievement as well. Then coming to the principal terms of the fund. Principal terms of the fund is one of the most important chapter, wherein you will be providing your complete details about the tenure of the fund, what will be the fee structure, what will be the minimum capital commitment, how the classes of units will be divided, and thereafter, what will be the distribution waterfall? So distribution waterfall will provide a profit sharing structure and distribution mechanism of the particular scheme of an AIF. Thereafter, we will come to the legal, regulatory, and tax consideration, wherein we need to discuss about the application of all the laws that will be applicable to the AIFs. This includes the SEBI AIF regulations, income tax regulations, SEBI circulars, SEBI various updations from time to time, also anti-money laundering regulations, and outline the regulatory and taxation implications with respect to the updated law in that particular chapter. So now let us discuss the disciplinary history. So we have to provide the proper disclosures on the regulatory or financial misconduct of IM sponsored trustee, if any, in the past. If any pending litigation is ongoing against any of the parties, then it needs to be duly disclosed in that particular chapter. Once the PPM is ready, we have to file few declarations as laid down under Form A. So what are the declarations? We have to declare that we were not involved in any litigation connected with the securities market, and order has not been passed against us for violation of securities law. Second, we are not involved in litigation connected with the securities market which may have adverse bearing on the business of the applicant. Thirdly, we have not been refused a certificate by the board or has not been suspended at any time prior to this application. Also, we are fit and proper person based on the criteria of SEBI Intermediary Regulations 2008. Once all this process is done, we have to appoint a merchant banker, because it is a mandate under Regulation 12 to appoint a SEBI registered merchant banker who will conduct an independent due diligence on the fund documents that we have prepared. Once he is satisfied that the documents are fully prepared, fully disclosing aptly things, then he will issue the due diligence certificate. After the whole process is done, we have to file our requisite documents with SEBI as per Form A. Firstly, we have to create an account on the SEBI intermediary portal for AIF registration by filling up the application fee of INR 1 lakh. Then we have to upload all the documents as per the sequence on the portal. We need to, again, verify the documents to ensure that we have aptly placed the relevant documents at a relevant header. Then we have to submit the hard. Once the documents have been sent on the SI portal, we have to submit the hard copies of the same to SEBI registered office. Once the documents are placed, we have to track the applications. What we have seen in the past is that there are general queries which are raised by SEBI, which we need to clear it. Once the queries are settled by the concerned persons, the SEBI will grant the AIF registration, taking into account the laws applicable at that point of time. Here is the compliance list that I have prepared with respect to the AIF. So it is firstly, there is an annual compliance audit report that we need to submit on 30th September annually. The responsible party is the fund manager. Secondly, there's a quarterly compliance reporting to SEBI as well, which is on 15th of the following of each quarter. It has to be done mandatorily by the compliance officer. Then we have investor reporting quarterly statements, which we have to do within 60 days of quarter ending. It has to be done by the fund manager. Then we have, if there is any change or amendment in the placement memorandum, then we have to update. The fund manager has to update within 7 days of any change in the event. Then we have annual valuations of portfolio investments, which we have to do it on before 31st of March annually. It has to be done by an independent valuer appointed by the fund manager. So this is the overview of the process we need to adopt while we are in process of forming the AIF. And we have to make sure that we are following the proper disclosures that has been laid down under law and the regulations. So this is it from my side, sir.
Thank you. Thank you very much, Vaibhav. Thank you. Now, Shivanshu, you have formed the Makia Capital. Can you just explain a little bit about this?
Yes, sir. I think I already spoke about this, but so market capital, I think everyone now have understood what the different categories are about. So it's a Cat 1 venture capital fund, and our moat is to invest in pre-IPO opportunities, in SMEs who are wanting to get public. So what we do is we create a whole roadmap for IPO advisory. We invest in them, and then we also take them public. We also invest maybe 20 to 25% of our portfolio will also be invested in preferential issues or distressed assets as well. So it's a diversified portfolio for us, and what we are targeting is to create good returns for our investors and and uphold the highest standards of integrity when it comes to managing a fund.
Okay. Now we have there's a role of trustee also in AIF. Okay. So Shivanshu, he's there, Mr.
Mahesh, 1 second.
Just talk to him. In the meantime, I'm
Sure.
yeah. Ravi, in the meantime, the trust point is
Yes.
coming. I'm just asking few things.
Yes.
One is that regarding investment by category Sec 2 AIF, as per the regulation, at least 50% of the corpus must be invested in listed security. In this context, would an investment in listed debt security which are issued through private placement qualify as investment in listed security to meet the requirement? Because listed security means listed security which is listed on the stock exchange. So, and the debt security is also coming into this. So what is your view? Though it's a complicated question, and somebody has asked, in my opinion, it should come.
In fact, in category 2, so far as the question is concerned, you have rightly answered, sir, that if the word is listed security, even the listed debt securities will be covered. But the fundamental problem is in category 2, and I request Shivanshu and Vaibhav to correct me. The major part of it has to be unlisted rather than listed.
Okay. So, yeah, Shivanshu, you have anything you want to say?
Yes, sir. I think debt securities which are listed are also included in that framework. So I think Ravi rightly pointed it out, and
Okay.
we're on the same page with this.
Okay, now SIF, which is new asset class introduced by mutual fund, is also a direct competition with AIF and PMS because new SEBI has come out with the new systematic investment things, which is in between the mutual fund and NPS. That is also, this is one comment somebody has given.
Yeah.
Can private or family trust be used to conduct investment activity for a smaller pool? Will that also fall under AIF?
Maybe Ravi can answer more on the trust side of
I
things.
don't think because if you have a family trust, you can do for your own business, own investment, but you cannot take public money. Public money, if you are taking, the trust is there, which can be used, but the AIF registration is compulsory.
Yes, sir.
Sir, how much time it takes to register category 2 if all documents are submitted? SEBI is also saying, because how much time you have taken, Ravi, the Shivanshu?
It usually takes 3 to 4 months. If one is very prepared, it takes 3 to 4 months. Otherwise, it may, if the documents are not properly aligned, they're not properly structured, the queries may take more time.
Okay.
There are rounds of changes that one needs to make.
Okay. What are the differential right given to investor? Can give some example?
I think Shivanshu would be in better position to.
Shivanshu, can you give?
So there are no differential rights. So for SEBI has mandated that on an overall structure there should not be any difference when it comes to different investors in a pool of fund. So that because what used to happen was different investors used to come at different set of obligations, right? So any investor who is participating can't take exit before any other investor. So it's like every investor is treated in a similar fashion, but what can happen is a fund manager can have different commercials with different set of investors. That could happen, but there will be no time wherein the fund manager will prefer one investor over the other. That can't happen in this structure.
Okay. Can there be different class of unit? What is the use of such different classes?
Yes, sir, there can be different classes of units. The use of these classes is, so for example, in my fund we have 5 classes, right? So there are different categories of investors that we have. So for example, if one investor is investing 1 crore and one investor is investing 10 crores, so every investor is then treated differently when it comes to the fund management aspect, because you can't treat a 1 crore investor and a 10 crore investor in a similar fashion. You might have to provide them with different set of commercial, which is then mentioned in different set of units as well. And there are two more parties as we have discussed. One is the sponsor entity and one is the investment manager entity. So for investment manager and sponsor who are backing the fund, there is no management fee or carry or performance fee of sorts. So what we do is we formulate different class of units to cater to different kind of investors that might be coming on board.
Okay. What is the pre-IPO lock-in category 3 AIF?
So pre-IPO lock-in, there is no benefit to a category 3 AIF and they'll have to be locked in for the period of 6 or 12 months. But in case of category 1 and 2, if they invest 6 months before an IPO, they have certain benefits, and the lock-in starts from the day of investment and not from the day of listing. But in the case of category 3, it starts from the day of listing. So that's the big difference when it comes to category 3 versus category 1 AIF.
Okay. As you are aware, Shivanshu, that you require a trustee role or trusteeship also. Okay. So, what is the role of trustee in AIF?
So I think the role of trustee is very because it begins from the day one when you are trying to set up a fund. The first thing that you'll have to, obviously, you can set up a fund as a company or an LLP, but most of the funds, 95% of the funds are set up as trust. And I think we have already discussed why most of the funds are set up as trust. But when we are setting up our fund, it's very important that you choose a trustee which can be beneficial for you in the longer term, because it's a very long term commitment. But just to lay down some facts, so key responsibility of the trustee would include they are the custodian of your assets, right? So trustees, like when you are formulating a AIF, these are the debenture trustees which are registered with SEBIs. So there is when you are investing in an AIF, you don't have to worry about where your funds are going. So you're directly investing in that trust, which is managed by SEBI registered trustee. And the trustee, obviously, as I told you, is the custodian of assets. They hold all the legal ownership of AIF assets, and it can't be like if the investment manager somehow makes any mistake or anything else, it can't be a burden on any investor that is coming in, right? Obviously, there could be a different call for different investments which might go wrong, but there is no, I would say, fraud risk when it comes to AIF, I would say. And there, obviously, trustee takes care of the oversight and compliances. They work in tandem with SEBI to formulate all the reports. They collate all the data regarding AIFs, and then they report it to SEBI as well. So it's like a mitigation mechanism for all the investors as well as SEBI per se. And other responsibilities will include monitoring the fund operations. So for example, if I want to transact on, as a fund manager, I want to transact or buy any securities, I need to have certain approvals in place. I need to have certain processes in place, even with the trustee and other third parties involved. So they monitor all the fund operations. They obviously ensure regulatory compliances. So they are the ones who are liable to report to trustee, or the trustee is liable to report to SEBI regarding what all the compliances need to be followed. And because trustee directly works with investment manager supplies all the documents to them, and then they take care of all the compliances part, including, periodic reports that you have to file, the investment limits, are they breached or not? And in case of category 3, you also have to provide what are the, what kind of leverage that you have on your fund. So it's a very, tedious process that trustee does it for you. And obviously it safeguards investor interest, because in the end it's the custodian of all the assets, right? So there is no, certain biases that fund manager might be having is mitigated by the trustee. The role of trustee is very central to the functioning of the whole AIF ecosystem, I would say.
Okay. So now we have covered everything SEBI has given a future outlook. So Ravi and Shivanshu, just tell me that how you are seeing the future, because no doubt if you see the other part of the world, which is whether USA has so many private equity hedge fund, they have multiple investment landscape, they are doing large scale investment in distress asset and technological driven companies. If you see all the technological company which are there in the main index, it has come out through this particular route. Same Europe also, they are doing green initiative, renewable energy. They are putting more and more the ESG based investment they are doing. In Hong Kong and Singapore, there are so many AIF because of favorable tax structure and investor friendly practices. They are there. And family office and sovereign wealth fund is also in plenty of this in Singapore. Now, all these things, in your opinion, what will take the shape when mutual fund started? We have seen mutual fund was it's a vanilla mutual fund. Then started mutual fund which can invest in only on the mid size or small size, and the index fund, and then thematic fund has come, then the arbitrage fund has come. Now there are thousands schemes are there. So do you think same type of thing will also come into this? A specific tech-driven platform, retail participation will also in a different way, technology, ESG focus. So what is future outlook? Ravi and Shivanshu, please tell.
Sir, I think definitely you have pointed out in the right direction that AIF industry is poised to grow, and I'll tell you why. Obviously, when we are based out of such a country, so I think we are one of the fastest growing major economy of the world, and if you look at what investment returns are provided by the blue chip stocks and even the small scale companies, and compared to startups, most of the value is created in the SMEs and startups of the world, right? And this is the risky capital that they strive for. It's not the debt capital that they look for. It's not the they look for machinery and anything else. These are tech driven companies which are creating value at the bottom of the ecosystem, I would say. And to back those companies, you need to have these AIFs, which can provide financing, risk capital, growth capital to those set of companies. And sir, on the second note, when it comes to the retail participation side of things, I think overall SEBI has been very active in tightening the regulations, and even bringing in the new regulations when it comes to new type of funds that can be formulated. So what I believe is the SEBI is more or less takes a call that retail investors need to be safeguarded from certain investments which they can't understand. And AIF is overall a very complicated structure to begin with. And obviously currently it's a 1 crore minimum commitment that we look for, and I don't think it will be reduced in times to come. But the set of investors, because we are a growing economy, the number of millionaires in India is increasing every year. So there will be more participation from the HNIs and UHNIs of the world. But I don't foresee a retail participation. Maybe there is as we talked about the new mutual fund scheme that is launched by SEBI, that also permits to retail investors to invest 10 lakhs in the multiple of 10 lakhs. But it's again not directly comparable to what AIF do. And it's a risky proposition, and they want sophisticated investors who understand this space, who understand the investment managers theme, want to invest. So I believe obviously it's poised to grow, but retail participation could be limited going forward.
Okay. Ravi?
Yes. So I feel, sir, there are two classes here, or two silos. One is who is going to put money in AIFs. That is very clear. These are all sophisticated and institutional investors, starting from as large as pension funds, international pension funds, or sovereign funds, to as as retail as HNIs, not in the retail sector, but this is the level of the spectrum, goes up till the sovereign funds, and HNIs are also included. So these are the people who are putting money, who needs money. Now this is the bigger compartment, and it virtually takes into account every industry and every company, because AIF is both sector agnostic and stage agnostic. It is also required for early stage ventures, even ventures which are at proof of concept stage or pre-revenue stage, and ventures which are at the advanced stages of their operations. So, because India is a fertile ground for the startup sector, and the existing industry is already in the need of money with the economic horizons spanning across the world, I think AIF industry is going to boom in India. And if you see the past track record, it has been consistently growing at a CAGR of double digits. It's sometimes even higher than mutual funds. And there was a study, very interesting study, after the AIFs were initially launched, comparing it with mutual funds and VCF. The trajectory was on the higher side so far as AIF was concerned. So I feel that this is going to grow, and more and more people will join in. There are, from the regulatory point of view, I think going forward, the AIF compliances are going to be more standardized. The same ideology of automatizing the compliances will be followed here also. Today, the measures that SEBI is taking for easing the burden of compliances, or for automatizing the burden of compliances for listed company, will soon be followed here. There will be better inter-regulatory cooperation, particularly with RBI, because a lot of foreign funds can be infused through this route of AIF, and welcoming offshore managers onshore for better management of indigenous AIF. I feel this is going to be the way forward. Regulator is going to move. And certainly, as you see on the screen, everybody, based on the reports and studies, they are saying that AIF industry is going to, it's a swelling market, and it is going to swell even further.
Okay. Now, the future outlook, just the next slide, this growth of AIF and the commitment which Madam Arpana was also mentioning. Just see the AIF 12,000, it's at more than 12,000, 43,000 crore rupees they have raised, they got the commitment. But which area is more? Category 1, category 2, and category 3. So do you think which is the most, I think category 2 is the most popular?
Yes, sir.
Because it is residuary category.
Okay, okay. For residuary category must be that you cannot do this, you cannot do, and rest this category two can do.
Yes.
Is it right?
That's how it has been divided.
So for category two, the major portion that is coming is from the debt funds. So
Yeah.
for if you want to invest in debt fund, you can't be doing it in Cat 1 or Cat 3. And as we all know, we all talk about equity markets, but it's a smaller percentage when it comes to the debt side of things overall. So that's how Cat 2 is very prominent. Even the government, PSUs and everyone uses Cat 2 to raise funds. So that's how it's, the numbers looks very swelled and it's deviated towards the debt side of things.
Okay, okay, okay. So this looks very interesting. The commitment raised and then the fund raised. That is very. Next slide, please. So just explain to this Shivanshu, what is the ESG sustainable investment? What in which direction they are going?
Yes, sir. So what is happening is obviously when there was an advent of AIFs, they were, initially we bifurcated into VC fund, private equity and hedge funds. But now even when we further bifurcate into, what type of VC funds are there. So there are some VC funds that have come up that just invest in renewable energy. So they'll just take exposure in alternative source of energies and everything else. And hence, if, as an investor, you would want to have then exposure to certain sort of industry, so you can look upon these kind of funds who are obviously bullish, or the investment manager strategy. You can understand those strategies and hence participate in those industries which you are really interested in. And I think we have covered it multiple times, but all the technologies of the world that we are currently talking about, when you talk about any AI technology, or when you talk about even renewable energy in the very latent, in a very early stage, everyone was once backed by a fund which believed in that idea and then went on to invest in them again and again. And hence that's how we see the disruptive technology that we are currently using today. Even chat gpt at one point of time was backed by a fund that is backed by Microsoft. Okay, so that's how I see the disruptive technologies need a lot of capital to be invested in, and these can't be provided by a particular individual, but a fund which has a good structure and good amount of funds to
Okay,
regularly update the technology.
okay, okay. Now future outlook for AIF future for India. If you can add something.
Sir, I think we obviously we have covered it, but as an AIF, as the AIF industry continues to mature, SEBI is also constantly working on better benchmarking and increased transparency, which will obviously increase the investor confidence in the longer run. So this can lead to greater participation from institutional investors, and I think overall, even foreign portfolio investors and foreign individual investors are looking at India, and when they look at India, they can obviously enter into stock markets in smaller ticket sizes, but they also look at funds to invest in. And hence, I think it's a very good opportunity for even for the world. As I said, Aparna ma'am was talking about 40% of the funds that are invested in AIFs are coming from foreign entities. So it's a very huge number, right? And I think it will continue in this momentum only. Sectoral growth, I think obviously there are traditional investments that can be made through AIF, but the theme of AIF in the current day and age is to invest in new age startups, new age sectors which are bound to boom in coming times, and hence overall country and every individual benefits from the same. And hence just extending this point, the innovation focus. So obviously there is a growing trend of AIFs to focus on a disruptive technology startups, and there are so many applications of AI currently, right? So what we have seen is the VC funds of this day and age are now investing in new age AI applications that are coming forward, right? And even we were looking at one opportunity which is regarding a financial product. So there are so many applications of AI. You just have to identify the right person who is doing the job and who can capture the market. So there is a lot of focus on innovation when it comes to AI, and I sincerely believe that there is a lot of potential to be yet to be tapped.
Okay, okay. Uh, uh, and in the policy making, any changes you think?
Sir, on the policy side, I think obviously when you are as an individual or even as a market practitioner, you are trying to set up a fund, there are a lot of compliances involved, which can involve many third parties, right? So you are working with fund accounting, trustee, you are working with RT. So I think the process needs to be streamlined a bit, and I think SEBI is working in that direction. So we have we have full enthu on that these changes will be implemented in a short while and will work in favor of the industry, so that there is no time drag that happens in this ecosystem. Regarding the tax clarity, so there is certain aspects of investments which require some tax clarity. For example, if whatever foreigner invests in your fund, what sort of tax liability, so there is no double taxation, you have to take care of this. So I think these problems need to be solved. I think there are more or less broader aspects laid down for it, but when it comes to interact because there are different tax authorities involved, so there is a lot of tax overlap as well happening in this ecosystem. So that needs a bit of a clarity. And again, I think innovation is at the root of what AIFs are doing currently. So I think it will continue to do so, and I think we are at that sort of juncture at India, that we will be seeing a lot more innovation focused business models coming up in next 5 to 10 years.
Okay. There is a few questions. Suppose sponsor is a QIB, NBFC and NDSI, and it invests more than 90% of corpus of AIF. Do the AIF still have QIB status?
Sir, there was a recent amendment to this. So what was happening is, so obviously any institution could set up an AIF, and then what they used to do was manage their own proprietary money and have a QIB status, and then they'll have also distinctive advantages of QIBs. But now what SEBI has mandated is more than 50% of the fund should come from different investors. And if any one investor is contributing more than 50% of a capital in an AIF, so they'll be losing the AIF status or QIB status. So I think that's also a corrective measure, because in the past we have seen that certain high net worth individuals, very high net worth individuals, were exploiting the QIB status for particular investments.
Okay. For category 2, what is the fund size generally suggested?
So there is no sweet spot for this, but what we have usually seen is the minimum that is required by SEBI to start with the first close is 20 crores, but it can go upwards of thousands and thousands of crores, right? So the maximum investors that you can have is 1,000. Okay. And so the sweet spot that we have seen when we are seeing all the pitches is approximately 150 to 200 crores, but depending on what the investment objective of your fund is and everything else.
Okay. So thank you very much, Shivanshu, Ravi, Vaibhav, Arpana Madam, and in absence of Mr. Sanjay Bhati, who has given the complete detail on the CIF. I think we have covered all points, all questions, and all the journey and type of fund, how it is helpful, what is the future outlook, what if you want to register the AIF, what are the things you have to do it. With this, so thank you very much all, and thank you my participants, those who have come and they have attended this program. So thank you everyone. Friends, the journey of this knowledge sharing will continue, and our next webinar is on 10th January 2025, succession planning through trust. As you are aware that succession planning people are doing it, they are making trust. So unlisted company trust and listed company trust, there are some specific condition, requirement, and how to do it, and how and why people are making trust, what are the advantages that we will discuss. Happy New Year to all of you, and till then, see you. We'll meet again on 10 January 2025 at 4 o'clock. Thank you very much.
Thank you so much, sir. Thank you, everyone.
शिवांशु, जरा आप लोग आना मेरे पास अपनी टीम को साथ.
Sure, sir.